I'm Yaneli, also known as Miss Be Helpful, with another FinCap Friday brought to you by NGPF. At the end of March 2020, one share of stock in GameStop was about $2.80. 10 months later, in January of 2021, their stock price exploded by more than 1,000% to a high of $468.49. But in order to understand what caused all this hype around a retail store that sells video games and electronics, you've got to know the difference between investing and trading. Investopedia defines investing as taking a long-term approach to the stock market. When prices go up and down, investors simply stick to their long-term strategy, which often involves adding the same amount of money to their investment account every month, no matter what. Trading, on the other hand, involves short-term strategies with the goal of making profits daily, weekly, or monthly. When stock prices go up and down, traders see this as a chance to make some quick profits from the ups and from the downs. But how does somebody make money when a stock price goes down? When traders believe that a company's stock price is going to drop, they can make a bet against that company. That's called shorting. In January of 2021, some leaders from Wall Street companies like Citron Research and Melvin Capital bet against GameStop because the company hadn't been making any profits and it wasn't showing any signs of staying relevant in the world of online and digital gaming. But chats and messages encouraging participants to purchase shares in GameStop spread throughout an online group with millions of participants on a website called Reddit. This pushed the stock price up higher and higher by creating lots of new demand. Melvin Capital and other Wall Street companies that bet against GameStop lost billions of dollars, and the media jumped on this story, letting everyone know that Wall Street investors were losing big money. Once people began to hear about the story on the news and see the memes on social media, more and more people wanted to buy the stock because the price was getting higher and higher. Not because they believed the stock was actually a strong investment. This is where things become dangerous. No matter how much money you might have, it's always important to remember a few things. Investing for the long term has resulted in wealth building for many, many decades, allowing people to retire with dignity, purchase real estate, pay for their children to go to college, create businesses, and so much more. But studies show that only about 10% of traders get lucky enough to make profits after taxes and fees, while about 90% of traders lose money making risky bets in trades like buying and selling shares of GameStop. While the thought of participating in trading just to make a quick profit is tempting, it's much more likely to lead to the loss of your money. And regardless of whether you're interested in investing or trading, it is so important to only use money that you're not relying on for something else, because money that you put into the stock market is not insured the way that it is when you put it into an FDIC insured savings or checking account.